I think most observers would agree that we're getting closer to the point of cutting rates, but not in the next couple of months. We don't expect the RBA to start cutting rates till February. But we can understand that they would not want to rule out a rate hike if something should happen. Our expectations about the rate cuts to come are all presuming that things turn out broadly as we expected.
When do you expect that the RBA would ever then take a rate hike, the possibility of a rate hike, off the table?
I think the closer we get to the date that they're contemplating cutting rates, once they're confident that underlying inflation is heading towards the 2 to 3% target range, then I think you'll start to see them take that language off the table. But while ever they perceive underlying inflation as too high, they're going to be more attuned to the upside risks than the downside risk to inflation, because at the moment they're on the wrong side. They're on the upside of that inflation target range.
What do you make of the RBA's emphasis in its statement on underlying or core inflation, given that the RBA is now forecasting core inflation in the December quarter to be at 3.4%? How close does it have to get before it will be prepared to start cutting?
As we've said for a long time at Westpac Economics, monetary policy operates with a lag, so you do have to start cutting rates before you're actually back at target. The RBA wants to see inflation sustainably back at target, and it uses these measures of underlying or core inflation as an indicator of inflation momentum. They're the measures that they use in their forecasting models, because while headline inflation is what people actually experience, and that's what they're measured against once we look back at a run of history, headline inflation can be affected by one-off factors like petrol prices, like fruit prices, and in particular at the moment, like the electricity rebates. That effect is temporary. They expect it to unwind. And so in order to look through those temporary effects, they're focusing on underlying measures like trimmed mean. But you're right, they're getting actually quite close to the top of their target range. So once they've achieved the required level of confidence that inflation's actually going to stay inside the target range once it gets there, then they'll be in a position to move.
Is 3.4% close enough?
I think there could have been some debate around that, but at this stage they don't seem to think so.
Do you see a time when the RBA will need to change how it looks at energy subsidies, prices and their impact on inflation?
I think it's important to recognise that if you do artificially reduce CPI inflation in this way, it does have a small year two effect in that prices that are indexed to the previous year's CPI therefore don't increase as much the following year. But it's a tiny effect. I think it's appropriate to look through any temporary factor, whether that's higher tobacco prices or lower electricity prices or varying petrol prices. It's appropriate to look through all of those things, and that's one of the reasons why the RBA has, for quite a long period of time, focused on trimmed mean in its forecasting framework.
We are staring down the barrel of a federal election. What if the major parties both promise to extend energy subsidies at some point during the campaign? What would the RBA do then?
Well, it would have to revise its headline inflation forecast for next year, for a start. I think there is a question about how long governments can keep tunnelling through the mountain, holding down energy prices versus, relative to what they would have been given where wholesale prices are. But that's a separate policy question.
What uncertainties does the US election this week present the RBA with?
I think it's inevitable that we'll see some market volatility over the next few days, particularly if the outcome isn't completely clear or isn't completely accepted early on. However, I think there are some commonalities, regardless of who wins and regardless of whether the winning presidential candidate obtains control of Congress. It's still going to be the case that the US federal government is going to be running enormous fiscal deficits. That's putting quite a lot of global demand into the system globally, and it's one of the reasons why we don't expect to see the kinds of levels of interest rates we saw in 2018, 2019 going forward.
Luci Ellis, thank you.
You're very welcome. Thanks, Kirsten.